Hi, Thierry.
Hi, Grant.
And what a beautiful office in the center of Geneva that you have.
Yeah, very happy to welcome you to our historic building.
So you're the head of private assets at Lombard Odier. And thank you very much for agreeing to chat with us today. As you know, we're running a series of conversations
My pleasure.
in the world of private capital. You told me that you're a fan of Arsenal Football Club.
I was, for sure.
But notwithstanding that, I'm sure we're going to have a fantastic interview. I was very interested to learn some of the history that you were showing me earlier of the founders and how the bank came to be all those years ago. It's got a very rich pedigree.
We've been around for a while, as you can imagine.
You were very kind enough to show me your new offices that are being built.
Yep.
And tell us a little bit about the One Roof philosophy and what you see unfolding in the next 6 months.
Sure. So hopefully, if we do that exercise again next year, we will be able to do it in our new headquarters by the lake, by the Geneva lake. Fantastic location.
Beautiful. And you've got incredible sustainability credentials in the new office.
Yes, absolutely. And I think, as you know, and we've discussed, sustainability is really at the core of many things that we do. It's a conviction that it will be driving a lot of economic growth, and it's not only an obligation.
Well, I look forward to seeing it when it opens at the end of 2024.
We're happy to welcome you there.
So tell us about your approach and Lombard Odier's focus on trying to create an opportunity for your clients and for clients generally to access parts of the market such as private equity, growth equity and venture capital.
This is one of the prime reasons of what we do, is to try to provide access to difficult to access markets and managers to our private clients. If we step back for a minute, to get a good allocation as part of your wealth, your total wealth into private markets, you probably need to do three things right. One is, to have a good level of diversification by manager, by thematics, and you mentioned, the more mature strategies like buyout, but you can have exposure to growth strategies, venture. All this will be part of the mix, and a good level of diversification, as in any allocation, is relatively important. But I would say that's probably the easy part. The second thing, and that's the most crucial one when you're talking in particular about private equity, is we all know there's a massive dispersion of performance in this world. And the ability to access the best managers will make all the difference in the quality of your allocation and your portfolio in private equity. And that's where modestly we come in. We've been doing this for a long time. We are invested with a number of, we're not invested with all the best managers, with pretty good sample of those good managers. And that's where we can provide access for, in a package and easy way for our private clients, where on their own, it would be near impossible for most of them because the minimum ticket is very high. Yeah. And, those managers are difficult to access. If you're not already invested with them, the likelihood is that you can get into their new fund will be difficult. Then on top of that, I think our second role is to help our clients construct those allocations in a smart way.
Do you expect increased appetite for private capital and private assets just generally?
Good question. I mean, there's many parts to this. I think the appetite for private markets is there. And I don't think has slowed down so much. Private capital wants to get exposed to private markets more. Yeah. So this is a growing trend, and I think it will not slow. And if you look at, the total assets under management for private markets, private equity funds, private credit funds altogether, it's 10 times smaller than the capitalization of all the listed companies in the world. So I think there's still ample room to grow. While at the same time, private companies represent 80+% of the total number of companies. So that's why we are convinced this trend, will not stop, and it will keep growing. Your point about timing and where we are in the cycle is interesting, because at the same time, when you look historically, the best vintages in our industry tend to be crisis vintages. So when there's dislocation in the market, fund managers who've invested in 08, 09, 010, or in 2000, 2001, typically if they do well their job, they tend to get better returns than in more bullish years. So our sense is we are in a market that is somewhat dislocated because of the change of environment and the rising interest rates. So our sense is it's probably a good time to deploy capital in this market. But at the same time, we are encouraging our clients not to try to time the market. And I think in private equity, timing the market is extremely difficult because, to your point, if you were investing yourself directly into companies, you can time the market to some extent. But we know that approach is very risky. If you are investing through funds, you're not able to time the market because your money will be called by those fund managers as and when they make investments. So you're really trusting fund managers to do this allocation on your behalf, and you won't be timing them. So our recommendation to our clients is to take really a long-term view, similar to what the endowment funds, for instance, in the US have been doing successfully for a long time, which is to pretty systematically build their allocation over time by committing amount of money across cycles long term.
So that brings us quite neatly into the question of illiquidity. Private assets, private capital, by definition, is an inherently illiquid market. What do you think is the attitude of funds or family offices or private individuals towards accepting that transaction, if I can call it that, between illiquidity and a higher rate of return?
I think so. But at the same time, it can be a very binary issue, and I think we are very clear with our clients. If you cannot live with this illiquidity and the patience required to build this type of allocations, you should not invest in private equity because it will create problems later on down the road. So I think one has to accept this illiquidity. But again, if we step back, we are convinced that introducing private assets into the mix of your investments provides diversification from traditional asset classes. And as you mentioned rightly before, performance has been good, so you get paid well for your illiquidity.
It has to be surplus capital that you don't need day to day.
Yes, absolutely. And I think, across our client base, we see anywhere between 10 to 20, 25% allocated to private assets.
So what do you think would be the main factors now that investors are thinking about?
At the end of the day today, good private equity managers is all about transforming companies. I think the good old days when I was working for a private equity fund, when you could buy a good business, lever it up and wait and still end up doing a good deal, I think those days are over. I mean, what we're looking for in the managers we invest with and we select is really this ability, this conviction to transform companies. And it's, I'd say capital today is become much more of a commodity.
Yes.
And it's more about, what can you bring to a company in terms of experience, network, skills, to really transform a company. There's many, many levers those private equity funds can use, to create value. But it's all about this, strong involvement with the business to transform it.
And there are lots of much smaller funds now that really go in and understand founders, really give them the opportunity and the backing, financial and philosophical backing to grow their business and take a risk. We're starting to see at Flatgate a growing trend that is emerging through intergenerational wealth and wealth transfer. There's more appetite, if I can put it this way, for capital to also do good in this world. Are you seeing any similar trends amongst your clients, and how does that playing out in terms of what you guys are, what Lombard Odier is offering?
We like, in our asset class, we like to talk about impact investing and impact private equity. And our conviction is that you can create a positive impact, and actually that this will also be driving performance, while at the same time not sacrificing your returns. It's not because you're investing, in companies that do generate a positive impact that you have to accept lower returns.
Yes.
And I think we see a number of examples of well-known private equity firms that have created dedicated strategies on impact and are able to generate similar returns than the more sort of traditional private equity approach.
So I think I read somewhere that over 80% of companies with revenues of over $250 million are in the hands of private investors, whether it's families, whether it's funds and so on and so forth. How do you think that's going to affect the market, and how are you positioning yourself for that?
You're absolutely right. I mean, and that's the starting point of all these discussions with our clients quite often is to try to convince them that only investing in public equities, you're missing out in reality a big part of the real economy. We're not arguing that these 85% companies, private companies, are all investable. And as you say, there's a lot of family-owned businesses as well. But I think private equity is a part of the answer to try to access that real economy. If you look today, there's less and less public companies. I mean, if you look, the level of IPOs have really slowed down for the last 15 years. I think a lot of entrepreneurs see the benefits or see some benefits of staying private longer. And we've got well-known examples of successful companies that want to stay private for much longer. There's much more capital to sustain those companies private longer. So we don't see that trend inverting. I think the proportion of private companies will remain very high. I'm not saying not having a good level of IPOs is a great thing, because ultimately it's one way for those companies to exit and create liquidity. But this is a trend that we have to recognize. There's more money since 2015, there's been more money on a yearly basis being raised by private equity or private assets funds generally than money raised on the public market for IPOs.
So as you know, we're a law firm based in London. What do you see are the upcoming legal and regulatory headwinds or challenges that are facing investors and players in the private capital ecosystem?
I think when it comes down to regulation, it only goes one way. So I think the industry has been expecting more regulation for some time now. I think the private equity industry generally probably could do better by being a bit more transparent, and I think the regulator will insist on that. In terms of reporting, I mean, there's been articles recently about the importance now of private credit in the economy and in the system.
Yes.
And obviously that's to some extent more difficult to monitor than the banks. So I think that's something the regulator will look at.
Yeah, we're seeing, more discussions around regulation of family offices, because they speak for significant amounts of private capital, but yet have no regulatory regime that kind
oversight,
of goes them. So yes, of course, I think it makes it adds some friction to the system, but in the end, it makes it more robust. It makes it more resilient, if I can put it that way. I think as lawyers, we're definitely seeing more and more opportunities or more and more circumstances in which legal input and advising on regulatory aspects, just growing and growing and growing all the time. Let's
not forget, in Europe in particular, we're already navigating a relatively, robust regulatory system, between MiFID II and the IFMD regulation for all those alternative funds. There are a number of restrictions that are imposed into how we can approach private individuals and private investors.
So Thierry, in terms of what you're seeing in the market at the moment, what asset classes are attracting attention? Where is there a flurry of activity? Where are things starting to move?
Very, very good question. I mean, if we run through the sub-asset classes very quickly, starting with private equity, we're still relatively constructive about venture capital, even though the environment is much more complicated. But our true belief is we are in the middle of a big secular trend. This technological revolution is not going to stop and will remain largely funded by private capital. So we're still very constructive about that. In terms of buyouts, I think on the large end of the spectrum, financing is more expensive, and that may take a little bit more time to come back. But mid-market, I mean, there's such a huge ecosystem of small, medium-sized companies, both in the US and Europe, that we see a deal flow coming back there for sure. Real estate is a tough market out there. That's a direct consequence of the rising interest rate. I think on the flip side, it creates opportunities for opportunistic investors. So I think that could be interesting. There will be more distressed sellers. So obviously, opportunistic buyers may be in a good spot.
Those that perhaps need to refinance coming up.
Absolutely, restructuring assets. I mean, there's many countries in Europe in particular where institutional investors like insurance companies bought real estate, in the last decade, thinking it was a proxy bond. and now they realize they have to manage it, and it's not the same thing. So we will see forced sellers in real estate for sure, and we are starting already to see forced sellers. And finally, infrastructure. I think it's more a belief that we are in the middle of the long-term secular trend. I think we all realize there's a strong need for investment or reinvestment in the core infrastructures of many developed countries, and we all realize that the state is not going to be driving that investment. It will come from the private sector, and mostly through this type of funds. So again, I think long term there's a good secular trend there on infrastructure. And finally, credit. I think it's more opportunistic in the sense that returns are very good for credit strategies because of where the interest rates are. Mm-hmm. That's not going to last forever, but I think we see a scenario where rates will stay higher for longer. So private credit will remain attractive for quite a while, I suspect.
Well, thank you so much for your time. Thank you for hosting us in your beautiful offices, and thank you for sharing your thoughts.
Thank you for having me, Grant, and my pleasure. We'll do it in London next time.
Yeah.